Yesterday, we scaled 17,000 intraday on the Bank Nifty, but you have seen some bit of a cooling off, and 17,000, mind you, is seeing strong writing. So you are seeing some bit of resistance at the 17,000 level for the Bank Nifty, 7,950 for the Nifty, and 7,900 is some bit of a strong support for the Nifty, a session ahead of expiry. Moving on, as we wind down a volatile 2015, all hopes are on the new year to bring some cheer back into Indian equities. So what's in store for markets in 2016, and what are the sectors and stocks to bet on? To discuss this and more, we are joined by Jayant Manglit, President of Retail Distribution at Religare Securities. Thank you so much, sir, for joining in on this show for today. We have seen a very muted 2015 and down almost 4% as far as the benchmarks are concerned. Going ahead into the new year, what are the kind of themes that you're looking at? What is the kind of outlook for starters as far as the Nifty, the benchmarks are concerned for you?
Yeah, so 2015 was, of course, a very eventful year. I think perhaps for stock markets, the most eventful since 2008. And a lot of the themes which are from 2015 will, of course, carry over to 2016. So two of them stand out for me. One is the geographies itself. So you had the US, which increased Fed rates, and we all know what the effect of that is going to be. And then you have the ECB, which is at a 180-degree opposite stance and is continuing with its stimulus. And finally, you have China, I think, that's actually the elephant in the room, because the last few years, a lot of the growth was essentially dependent on China. So between these three, all these factors are going to decide how 2016 is going to pan out for the stock markets. In all of this, the silver lining, I think, for India is that we are truly in a sweet spot. So, with low inflation and high growth, we are a market which nobody can ignore. So, admittedly, some money has gone off the table in the last few months, but I think all of that and probably more is going to come back in this year. So, I think 2016 for India is going to be a good year as far as stock markets are concerned.
All right, then, fair enough. What about retail participation? We have seen DIIs holding fort as far as that is concerned, and almost matching up with the FII exits as we have seen ever since the months of April and May. A lot of money via the mutual fund route. Mid-caps have seen a lot of excitement across the board. How do you feel retail will hold up going ahead into 2016?
Right. So I think this will have to be looked at in two parts. One is, of course, the macro part, which you said. So you say that, for example, in the BSE 200, the DII participation in mid-cap, they've bought more than what they bought in the last 2 years. It's moved up from about 7.5% to about 9% of that. But if you look at it even at an individual level, I mean, a retail investor, and we have a lot of them. We have almost 1 million registered clients. So they put in smaller amounts, they'll put in for short periods, and most importantly, they don't want to lose money. And that losing money is what keeps them away from this market. So I think 2016, the people who are giving the advice, they need to essentially pull up their socks, give better advice, and the investors who are investing also need to pick and choose who they're going to follow and how much of the money will be direct equity and how much is going to be through mutual funds.
Fair enough. Jayant, also, let's focus on the top themes that you have written about as far as your coverage is concerned. I understand there is consumption as well as auto and private banks. So let's take it up piece by piece. Let's start off with the FMCG space. A big commodity price fall that we've seen aiding the kind of raw material cost, and some of it has also found passage to end user prices. How do you see the margins panning out? What is your rationale as far as the consumer space is concerned, and how positive are you going ahead, given that we've seen a further decline in crude in December?
Yeah, so I would actually pick up all of these four, and some of the rationale is pretty straightforward. So in FMCG, for example, a lot of it has to do with the urban demand. So the consumption story is still very strong. Rural demand is not bad at all, and I think a good monsoon will be the real big kicker for this, where rural demand can actually completely change the flavor of the game. So FMCG is a special space where it is not only defensive, but if the monsoons are good, it can also be a good aggressive play for this year, and therefore we think that this sector is one which everybody must, of course, have. The second one which we spoke about and we recommend as a sector is the automobile sector. And I think they're getting benefits from both ends. So one is you have the raw material costs which have gone down, all the commodities which they use, metals to make those automobiles, a lot of that is going down. And you also have good demand in automotive. So you've seen all of that. And this is not only true of automobiles, it is also true of the ancillary industry which is there with automobiles, because they stand to benefit clearly from the number of auto sales which are going up. Third, we've been recommending private banks. And I think, again, that is pretty straightforward. If there is an India growth story, and there is, I think that's a really good growth story which is there, one of the finest in the world today. In that, banks are going to play a big role. Now, nationalized banks, they have issues around asset quality. And I think that is something which private banks, their operational efficiency is higher. Private banks are also able to match up or even lead some of the technological innovations which are there, mobile wallets and all, which will make it do even better. So I think private banks, once again, is going to be a good sector for 2016 and in fact beyond, as long as the India growth story is there. Finally, I would also say in terms of these sectors, there is also IT. So IT, again, they are winning on both ends. So you have demand. So the US is starting to do well, and we know that because they're starting to hike interest rates. So a lot of the large companies which are getting orders from the US, they will do better. Not just that, because the dollar is getting stronger, there is a double benefit for them as they convert their earnings into rupees eventually. So I think between these four sectors in equities, there is a lot of play which is not only going to happen in 16, but perhaps beyond.
All right, fair enough, Jayesh. Let's take it up sector by sector. So first of all, you were focusing on the consumption space, and there I understand you have a positive coverage on Britannia. You are betting on their rural foray, tier 2, tier 3 foray, as well as their premium and super premium biscuits. The stock has returned 70%, one of the better picks from the mid-cap FMCG space. Take us through your detailed rationale on Britannia.
Okay, so see, before we just get into this, I'm saying what we've done is that 2016 is a special year because there are a lot of uncertainties. So we actually ran this through a filter of essentially 6 points, which was we tried to make sure that the leverage was under control. We said that the cash flows have to be good. We said that the net profit margins have to be in place. The brand should be well known, so we don't want like a startup. We're not betting on that for this year at least. We want that the demand should be obvious that there is demand, and finally they should have a clear expansion plans. So if I was to, for example, take Britannia through this filter, then it actually comes down to, you look at the leverage. They have zero debt, and I think it's a big plus for that. Secondly, their net profit margins are comfortably over 10%, which and have been for years. So it's not something which they're new to. Cash flow has not been a problem. For the last several years, they have got great cash flow, and I think that's very important for any stable business because we are talking about retail investors investing into these companies. As a brand, you will see that Britannia is doing, there's no introduction which is needed to the brand. Plus, if you look at the rural and urban demand which is there is a lot to do there. They've also focused on the premium and the super premium segment where there is less competition and the margins are extremely high, and Britannia has a good distribution already. And finally, if you look at the expansion plans, then they have a agro processing plant coming up at Chittoor in Andhra Pradesh. So when you go through this entire filter which we've set up, we wanted to only recommend companies which are well known, which have a history and which have a clear future. And in that, I think Britannia truly fits the bill.
All right. Jayant, moving on, as far as the home building space is concerned, you have coverage on Century Plyboards as well. The stock hasn't done much on a yearly basis. I mean, just a 10 to 15% of a return. But you are positive on their raw material sourcing. They're entering into, they're broadening their product basket and so on and so forth. Do you see the fundamentals here altering, and how big, what kind of a proportion are you assigning to the home building theme and the stress on housing for all and so on and so forth, the government plan as such?
Right. So once again, a lot of positives here. I mean, Century Ply, we run it through the same filter, and you see that it is a well-known maker of plyboard that again needs no introduction in the sector or within the consumer space. And they've started to make furniture and modular kitchens, and a bit more on that later, which is a high margin space. But if you run it through the prism, then once again, leverage. So they have got debt, but their debt equity ratio is comfortably less than 1, and I think which is very good. Second, in Century Ply, the net profit margins they exceed 10% already, and we are projecting that over the next couple of years it will in fact exceed 12%. So which is that's good from the investment side. Then cash flows, very positive. In terms of the brand, they not only run Century, for the rural market and the low-cost market, they have Scenic as a brand. And for the furniture and the modular kitchens, which I spoke about, which they sell only in the south and east currently, the brand is Nesta, which in those areas is well known, and it is that makes the company actually a multi-product company now with good margins, especially on this side. But as you said, that the big theme is the increase in demand in this, and which is the seventh pay commission coming in. And I think what's special about that is that once the seventh pay commission has been announced, a lot of that is going to overflow. So the state governments are going to have to do this. We know this from all the previous pay commissions that have come. And then even the public sector employees will be, essentially eventually getting a hike because of this. So because of that, you have actually millions of people across the country who will have new discretionary income. And some of that will, of course, go into, for example, EMIs for buying cars, etc. But some of it will also go into refurbishing houses, where companies like Century Ply stand to benefit. So I think if you really look at it, demand is a big theme for this and going ahead. And secondly, in terms of their future expansion plans also, they have gone in for a sort of vertical integration where they have set up a unit in Myanmar so that their timber supply, their raw material security is in place. So once again, through the filter and specifically on demand, Century Ply remains a place where retail investors in general, in fact, can invest for 2016 and a few more years after that.
All right, fair enough, Jayant. In the same breath, let's also talk about Somani Ceramics. We are, in fact, hearing about the imminent import duty as far as the tile manufacturing is concerned. We understand from your report that the company is also planning expansion in their tile manufacturing capacity, as also themes like, obviously, smart cities and the DFC that you're betting big on, and the Swachh Bharat campaign. Take us through your rationale as far as Somani Ceramics is concerned.
Right. So once again, running through the same filter, and I think that just makes it simpler. Somani Ceramics, well known. It is there in tile. It's one of the leaders, and it's also there in bathroom fittings. But tile is where it is. It's an old company. It's about 45 years old. So leverage, again, they have got debt on their books, but the debt equity ratio is about 0.7. It is comfortably below 1, and so they're using the money well on that. The margins in this industry, and that's industry as a whole, are low. So the net profit margins you will find here are less, and they'll be typically less than 4%. But it's a high volume, low margin kind of market which is there in this. Cash flows are strong. They've never had a problem on this. But as you said, demand is a big theme in this, and which is that, just like Century Ply, some of the reasons remain the same. So the seventh pay commission is going to make a big difference. In addition to that, Swachh Bharat, a lot of the construction which happens because of that is going to need tiles. And also CSR activities, as they increase, a lot of that is going towards that as well. So in terms of demand, I think, this is pretty much a sitting duck. I think, over the next, for 2016 as well as the next few years, this is one sector and perhaps one company which is set to do well. And which is why, in anticipation of all this, they are going to increase their tile manufacturing capacity over the next couple of years. And I think it's also pertinent to mention that in terms of operating costs, they are likely to come down because of the
all right. Jayant, sorry to interrupt you. For paucity of time, let's move on as well to another sector that's interesting, and you're maintaining an avoid there as far as metals is concerned. Now, do you not think that a lot has happened, and do you not see a bottom as far as steel as well as base metals are concerned? So in that, are you not seeing a recovery, albeit protracted, going forward into the new year?
Right. So see, look at 2015 specifically. I mean, copper was down 20% in rupee terms. You had crude oil, which was down 30%, 60% over 18 months. Nickel is down 38%. So you have a sector which was essentially pushed down, and nobody can take the call where the bottom is. 2016 is going to see multiple increases, at least 3 increases perhaps in the US interest rates, which will lead to a stronger dollar. A stronger dollar directly affects the amount of demand which is there, because it makes it more expensive for others to buy the same commodity. So I think it will turn around, but whether the time is now or later, I think it is definitely not now. I see the opportunity coming, if at all, more towards the end in the last quarter of 2016 than earlier. So for the first 9 months, I would say forget it. The time is not now to get into this sector, and when the time comes, we will just know, because first the interest rates in the US need to stop, and secondly demand in China needs to pick up. When we see proof of that, then I think this will be the sector to get into.
All right, Jen, that's about time we have for accommodating this. And thank you so much for joining us with your top picks as well as your strategy going ahead into 2016 and accommodating this interaction request for today on Bloomberg Bottom Line. Well, moving on, up next, an exclusive conversation with market guru Nilesh Shah. He is optimistic on the markets in 2016, but cautions that the earnings recovery will be gradual. Stay tuned.
I'm quite hopeful about 2016. Even if we reach to the high of Sensex, which we touched in 2015, it will still give you 20% return.